And joining me right now, Thomas J. Hayes is here, Chairman and Managing Member, Great Hill Capital, LLC. Glad you are here. So you watched that inflation report today, and you're watching whether or not the Fed may or may not cut. Your thoughts?
Well, I've been walking around the floor here. I can't find a bear anywhere. It's mind-boggling. All the same people who were bearish the whole way up, and we've been publicly very bullish the last year and a half. And I got to tell you, Nicole, this is the first time the last week and a half, we started to put portfolio hedges on. We are fully invested long, but we've allocated 2% of equity capital to hedge out our portfolio, put spreads on the S&P 500, put spreads on the semiconductor index. And the interesting thing about this morning is it was hotter than expected across the board, except for month-on-month headline inflation. And yet the expectations for cuts in June barely moved, still 70% expectation of a cut in June.
What might we have seen? I mean, what do you think that the Fed, because of all this that, we wait for the PCE too, right?
Yeah.
So
the PCE is what they're looking for. We also saw on Friday average hourly earnings came down. Generally, things are humming along. Earnings expectations for this quarter went now with 99% of the components having reported, up 3.4% earnings growth versus estimates they were expecting 1% earnings growth.
Right.
Except we're trading at 21 times forward, so we're getting a hair rich, and I want a little bit of protection even though we remain fully invested.
Understood. So you said maybe you're expecting a pullback to the tune of what, 3 to 8%?
I think that would be a reasonable range. And if you look in election years, number one, since 1928 on average, they're up 11.28%. So we're very constructive for the year.
Right.
But this period of late February through mid-April tends to be a period of seasonal weakness on average for the last 50 plus years. This would be a good time to take a breather, especially, with the S&P up 28% since October.
Sure.
Semiconductors 68% since October. That's a big run in a short amount of time.
It's pretty amazing, really, when you think about the run, because I'm not sure everybody expected it, right? You had a terrible year, and then things started to come back. And at this point now, if you do see these pullbacks, 3 to 8%, would you be buying on dips? Like, at what point would you say, I'll buy?
Yeah, there's no question about it. We are not having a problem putting money to work. There still are values in the market to go long. As far as buying the general indices, we think they've gotten a little bit ahead of themselves. Some subsectors like semis maybe a little bit ahead of themselves. Yeah. But there are values. You're seeing a greater broadening in the stock market of more sectors participating. We think there are opportunities in small caps. We think there are opportunities in mid caps. But one of the companies that we really like that we've owned for a little bit here is Stanley Black & Decker. How boring can you get? They've got tools, okay? They've got Stanley, they've got Craftsman, they've got Black & Decker, they've got DeWalt. And they over-inventoried during COVID. They bought a lot of inventory when they thought they couldn't get it. They've worked through that over the last 6-7 quarters. They're now inflecting. They're taking $2 billion out of costs out of the business. They're well ahead of schedule on that by 2025, which amounts to about $13 a share in savings, and their historical multiple is 16 times. So just on the cost savings with an average multiple, you're looking at $200 a share of value. The stock's only trading at $91. And the last time that they got their margins up to 35%, which they're also ahead of schedule on the margin recovery, they're at 30% gross margins right now, they had $8 a share in earnings, and they were trading around 153. Just on the cost savings, they're going to have more earnings than that, and the multiple expansion. So we think there's a lot of upside over the next 12 to 36 months in Stanley Black & Decker. Boring stock, exciting outlook.
No, people love tools and things. It's at $90 and change. I mean, is this a $100 stock? Is this a $110 stock, maybe?
Well, it's a $90 stock now. We think it can be a double over the next 3 years. So
double over the next 3 years. Wow, that's a big call.
Margin expansion, huge cuts. It's down 55 right now, so we're looking for a reversion back up towards all-time highs, and it's going to take a little time, but they're on the right track.
That's amazing. Okay. How about Genera?
Genera, another boring one.
It's a fun one. You need a generator if there's like a wind or a tornado or some catastrophe.
They're number one in the home standby generators. They also do commercial. 70% of the market they control. Again, everyone couldn't get parts, couldn't get supplies during COVID. They all over-ordered. They've worked through those inventories over the last 6 quarters. And here's what's interesting about this one. Stanley Black & Decker's down 55% off its all-time highs. This one's down 70% off of its all-time highs. And last quarter, they generated record free cash flow, $266 million of free cash flow, 354 for the year. So in a turnaround story, the number one thing you want to see is that they have free cash flow to execute the plan, because the big thing with turnarounds when stocks fall is, are they over leveraged? Are they going to make it? In the case of Genera, that's not the case at all. All we needed them to do is work through the inventory, and as you can see from the free cash flow and the orders and the acceleration of the business, that the worst is behind them, and this can really re-accelerate quickly now.
There's been so much talk about what the Fed should or shouldn't do. Even the Fed said we don't want to cut too early. We don't want to raise again if we don't need to. It's sort of this catch-22. Jamie Dimon noted that the Fed shouldn't cut too fast, and warning that a recession is not off the table. So what's the final thought here? Are you worried that the Fed may make a move that they shouldn't?
I'm worried that they don't make a move that they should.
Tell me.
I think the sooner that they do the first cut, the less cuts they'll have to do. I think if they actually move on the first cut, they might only need 1 or 2 cuts like we saw in that 1995 inflection. If they wait too long and we need more than the 3 cuts that everyone's looking for, that could signal that we have bigger problems and they waited too long for the lagged effect.
Interesting, because that's different. I mean, there are other people who think if they cut, it means that we're seeing a lot of deterioration.
Much easier to solve inflation than deflation. If you let it go too far, the amount of cost to society to bring us back from deflation are enormous. If they go too early and inflation spikes a little bit, they can always hike again. It's not a big deal.
Right. Okay.
Yeah.
Thank you so much. It's great to see you.
Thanks,
Thomas
Nicole.
J. Hayes,
Appreciate
Chairman and Managing Member, Great Hill Capital.